Hey everyone, thanks for tuning in to this month's investment update. We're going to spend about 15 minutes walking through some data that's hit our radar screen of late. And the hope is that we cut through some of the noise of the day-to-day headlines that are out there. So here's the agenda for today. Many of our indicators have recently become constructive and suggestive that the rally since June is more than a bear market bounce. Those include technical price action, some receding in the volatility, inflation, confidence, and interest rates. Now, if the first half of the year, from an economic perspective, represents the worst of the economic slowdown, there could be some value here in some economically sensitive areas, particularly something like the small cap space. However, there is a bear case to be made on the economy, and a balanced approach really requires us that we examine that as well. So we're going to do that in the webcast for this month too. So starting with the big gorilla in the room that is inflation, the top clip of this chart shows that deliveries have improved, as has the backlog of orders. Inventories have moved significantly higher, and price pressures for manufacturers have softened considerably. Now, these are all leading indicators of inflation, particularly on the goods side, and they're suggestive that inflation is likely to slow in the upcoming months. And that's likely true even if oil prices rise from here. BCA Research recently created a very thorough estimate of inflation over the next 12 months. And in their model, they modeled out the components separately, including energy prices, food, shelter, goods, and services inflation. And the result is this gray cone in the top clip. It ranges from 2.4 to 4.8% inflation over the next 12 months, with the high end occurring due to a 20% increase in oil prices from here. And even though a 4.8% rate of inflation is still quite high, it would represent a significant deceleration from the 9% plus inflation that we saw at the peak here this summer. Now, we featured this chart in our webcast from June and noted that if inflation were to peak, that could be some really good news for markets. And what this is showing is the average annualized change in share prices under different inflation regimes. And note that the worst outcome has been the months following very high inflation that actually accelerated. So when you have a rate of inflation of 8%, and it goes from like 8% to 8.5%. That would be an acceleration in inflation from a high level. And that's largely been the case in 2022. But the market has tended to stage a comeback when inflation decelerates, even from that high starting point. And the best returns have historically come when inflation breaks below 8% and is continuing to fall. Now, we're not there yet below 8%. But we could be headed in that direction over the fall and the winter. Now, a reprieve in inflation pressure would certainly be a welcome sight for consumers. So here we're showing consumer sentiment in light green, hitting its lowest level ever. And it's doing that because inflation adjusted income just flat out hasn't kept up. And that's the dark green line here in this chart. Negative real earnings are enough to sour anyone's mood, really. So it's no surprise that consumer confidence is pretty low. But a funny thing did happen last month. Consumer sentiment actually ticked higher for the first time in a long time. And here what we're showing is that same consumer confidence index from the last slide in purple. But this series is updated with the latest data. Now in orange, we're plotting gas prices. Now these series are not perfectly correlated, but it's clear that the consumer mood is impacted by the price at the pump. So perhaps unsurprisingly, as gas prices have come off, sentiment has been showing signs of improvement. Now, should the low in sentiment back in May prove to be the lowest level in consumer confidence of this cycle, that could have positive ramifications for forward market returns. Now, the numbers in this chart show the 12-month forward returns for the S&P 500 index following peaks and troughs in consumer sentiment. It identifies 8 prior sentiment lows, and we can see that the forward 12-month return off of those lows has averaged 25%. Now, as investors, we need to ask ourselves, do we think sentiment's going to go from already record low optimism to even worse optimism, or is there a path for confidence to improve from here? Now, another trend that has shown signs of improvement is in interest rates. Now, one of the biggest headwinds the market has faced in 2022 was in swiftly rising interest rates. Now, we can see in the chart here that when the 10-year Treasury yield rises quickly, the markets tended to deliver negative returns. And that's been the condition for really much of this year. But more recently, rates have begun to stabilize, which has historically been a bullish condition for stocks. Now, you might have read that Jamie Dimon, the CEO of JP Morgan, was recently quoted as expecting what he termed an impending economic hurricane. Now, we've actually heard quite a bit of lower guidance due to economic uncertainty in the Q2 earnings calls. Executives have broadly leveraged the uncertainty that exists to talk down their future earnings growth, and they've done so pretty effectively. So what we're showing here is the estimate for forward earnings growth for the median company in the S&P 500 index. Now, we came into the year with earnings estimates that were frankly way too high. Historically, stocks have fallen when earnings estimates were that high. But now earnings estimates have fallen to a level that's not overly optimistic, and companies may broadly be able to exceed expectations in the year's second half. Now, finally, market technicals had improved greatly off the June 16th low. Now, we're not big proponents of levels or anything like that. Like, we don't draw a line in the sand and say 4,000 is the be-all, end-all level for the S&P 500. But what we do like to pay attention to is data that we can quantify. Now, here we're showing the percentage of S&P 500 stocks that traded above their respective 50-day average price. Now, that got to 90% recently. Extreme strength shown by the majority of stocks at one time is what is called a breadth thrust. And these types of thrusts in strength, they tend to show up near the start of a new bull market, not necessarily during bear market rallies. So here's a table that breaks out the performance of the S&P 500 following those similar breadth thrust signals. 1 year out, the market has averaged a better than 18% gain. And it's only been down in one case back in 2010, which actually wasn't a bad time still to be an investor. Interestingly, this last shorter term thrust signal, it occurred when most stocks were still in relatively weak long-term trends. Now, the gray highlighted cases here, those are the 3 other instances when breadth thrusts occurred, but the long-term trends were still pretty weak. And those were April 2009, October 2011, and May 2020. Now, all 3 of those were near the endpoints to major bear markets. As for what could benefit if the consumer begins to recover and the market continues a positive bias, we take a pretty hard look towards small cap stocks. Here we're showing the average trend in small cap stocks relative to large cap stocks around bear market bottoms and also recession end dates. Now notice that small caps tend to begin outpacing large caps once the market bottoms, and then they continue to do so in the 12 months following the start of an expansion. So if the worst of the economic downturn was felt in the first half of the year, that could be a good thing on a forward look for small cap stocks. Now, small cap stocks are also pretty cheap on an absolute basis and relative to large caps. So here in the middle clip, we're plotting the price to earnings ratio for large caps in blue and the price to earnings ratio for small caps in black. We can't quite say that small caps are as cheap as they get, but they are in the ballpark. And in the bottom clip in red, we're showing small cap valuations relative to large cap valuations. And we can see here again that small caps are cheap when compared to large cap shares. So the bull case is that the worst of the economic slowdown is now behind us and consumer confidence should improve with stabilization in commodity prices, inflation, and interest rates. Now, past instances of sentiment improvement from bombed out levels has preceded past bull markets. And that's our base case, just to be clear. But it would be foolish for us to ignore the other side of the argument. There is a bear case that one could make. And we'll first start with the yield curve. The yield curve is the difference between a longer-term treasury rate and a shorter-term treasury rate. Here we're showing the 10-year treasury minus the 6-month treasury. This calculation went negative at the end of July, and past instances of a negative yield curve have tended to lead recessions by 11 months, and they've never lagged a recession start date. So this would argue that the first half of this year wasn't a recession, but a recession will be coming in 2023. Now, a common question we get is this, but aren't we already in a recession? And I can make the case that we should just keep the definition simple and say, yes, output is contracted for 2 quarters, we're in a recession. But like most things, it's much more nuanced than that. First, sales were up 14% year over year for Q2. Corporate earnings were up about 9%. Unemployment has continued to trend lower. And like the yield curve, the unemployment rate has always bottomed ahead of a top in the economy. Call the first half of the year whatever you'd like to, but as investors, what we care about is earnings, and earnings were up 9% in the second quarter. But remember, I said that the bear case is that the recession hasn't happened yet, but it will. So when can we expect layoffs? Historically, layoffs occur when the cost of employees exceeds the growth in sales. Here in this chart, the blue bars are the year-over-year change in sales per share. Sales were up 14% in Q2, and the orange bars are the yearly change in employment costs, and that was up about 5% in Q2. So sales are still far outstripping employment costs. Now, if that changes, then we can expect layoffs and a higher unemployment rate, but there does appear to be some solid space between the two for now. Now, employment costs will likely be pretty sticky, so what could drive that decline in sales? One culprit could be the freeze in housing activity. Here we're showing home sales in red. They've been declining on a year-over-year basis. Now, when home sales soften, that tends to lead slower retail sales by about 6 months. Now, there's a few reasons for this. First, directly, businesses that focus on home building and home improvement, those clearly take a hit from slower housing activity. And also, negative housing activity has typically been a symptom of a sour consumer mood and affordability issues. So while retail sales have generally been okay for now, that could soften in the next 6 months, dragging down total activity and throwing us into a more traditional recession. Now, of course, we have to muddy the waters even further. Not all recessions are created equal. Recessions typically relieve some excess in the economy. The more excess, the deeper the recession needs to be to relieve the overdone conditions. But the traditional cyclical areas of the economy don't look stressed right now. This chart is showing housing investment, which absolutely soared before the housing bubble burst. And that looks fine for now. It shows business investment, which has also jumped prior to recessions in the 1970s and notably the tech bubble. And that also looks okay for now. Autos are probably underdone right now. We usually see auto sales at a high level at some point prior to recession. Well, even if it's because of supply chain issues and folks just can't get cars even if they want them, auto sales are low today. And finally, inventories are still pretty tight relative to sales. So here we really can't see any cyclical excess in the economy. Well, you're not going to get to a 9% rate of inflation if there's just no imbalance in the economy at all. We'd argue that an imbalance does exist today, and it's in the difference between goods and service spending. Now, note that goods are still comprising a bigger share of the consumer spend than they were pre-pandemic. Spending on services, it still looks like it's pretty low. It's too low as a share of total spending. So we have an economy that's been optimized for services, but we've seen an increased amount of spending on goods. This imbalance is still trying to work through the system, but we're not quite there yet. But we don't think you need a severe recession to correct the overspend on goods and the inflation due in large part to a tight labor market. We don't think you need much of the way in job losses to get that inflation rate down meaningfully. So here we're showing the so-called Phillips curve for two different periods when unemployment rates fell below 3.5%. On the left, we're showing the 1960s, and on the right, we're showing the post-COVID shutdown recovery. The vertical axis of each chart plots core inflation. The horizontal axis plots the unemployment rate. Note that the unemployment rate seems to have little correlation to inflation most of the time. But then when the unemployment rate falls to very low levels, inflation seems to move precipitously higher. But the relationship also suggests that as unemployment moves above 4%, inflation is likely to fall back into a normal range pretty quickly. Finally, with the passage of the Inflation Reduction Act, I did want to just touch on the market impact briefly. Strategic Research, one of our research partners, did some very good work on the likely impact to corporate earnings given the 15% minimum tax. It definitely varies by sector, with utilities and financials the big losers here. In total, though, it would shave about 1.5% off of 2023 earnings growth. And that'd be in a complete vacuum with nothing else going on. So all told, it doesn't look like it's nearly as penalizing as at least those initial versions of Build Back Better that were being floated. Now, we plan on reporting more on some potential midterm and post-midterm year trends in next month's webcast. So certainly tune into that if you're interested in some of those implications. So to wrap up our thoughts, first, our base case, given the current evidence, is that a new bull market began in June. And as evidenced by the last few days, we shouldn't just expect just a straight line higher. But we do think we're in a new bull market. Should the year's first half weakness in the economy prove to be the worst of it, some economically sensitive areas like small cap stocks look attractively valued, and they could be a good way to play an improving outlook. Now, there remains a bear case though, and that is the possibility of a 2023 recession. But even if we get a recession, it may not necessarily take much in the way of contraction to soften inflation quite a bit and relieve that excess in goods spending from the economy. Now, finally, a quick thought on the IRA. It looks like the impact to earnings will vary by sector, but the overall impact to corporate EPS should be pretty mild, at least on the back of the envelope in a vacuum sense. So that's our prepared remarks. I'll see if there's any open questions now and flash up our disclosures screen. So it looks like we don't have any questions this month. So thank you all for tuning in. Again, next month, we'll try to go over some of the midterm election tendencies and some trends that we see there. And until then, we appreciate the time.